On March 28, 2024, COMEX released a routine silver inventory report. No headlines followed, no alerts were triggered, but buried in that document was a line item professionals watch closely. Registered silver fell below 75 million ounces. That level has only been breached during moments of extreme market stress. And yet, the price of silver did not move. That silence is the signal. Because when supply tightens and price stays calm, it means someone is preventing discovery. Silver does not trade in one market. It trades in two, the market you see and the market that delivers. COMEX prices, silver through futures contracts, but fewer than 1 out of every 10 contracts now results in physical delivery. The rest are settled in cash, rolled forward, or quietly closed. This allows price to remain stable even as deliverable metal drains. This wasn't always the case. Before 2019, delivery rates were significantly higher. The decline accelerated after one event. In 2020, global supply chains fractured. Mining slowed, refining bottlenecked, transportation delayed. At the same time, industrial demand for silver surged. Solar installations expanded, electronics production intensified, defense stockpiles increased. Silver stopped behaving like a precious metal and started behaving like a strategic input. Here's what changed after 2020. Silver stopped coming back. When silver enters industrial systems, it is not recycled efficiently. Unlike gold, silver is consumed in trace amounts across millions of units. That makes recovery uneconomic, which means every year the available above-ground supply shrinks. This is why deficits since 2021 have not corrected. They have compounded. Normally, markets respond to persistent deficits. Prices rise, supply increases, demand adjusts. That hasn't happened. And that brings us to the real question. If silver is structurally disappearing and prices are not responding, then where is the pressure being absorbed? Because pressure doesn't vanish, it transfers. By mid-2023, analysts began asking the wrong question. They asked, is silver running out? The correct question was, who is taking delivery and not returning it? For decades, London and New York were the center of physical silver custody. That has changed. Since 2021, physical silver flows have shifted east. The Shanghai Futures Exchange has reported consistent increases in physical silver deliveries. At the same time, Western vault movements have slowed, and not stopped, but slowed. Metal enters, it does not exit. This is not retail demand. This is not coin buyers or small investors. This is industrial and state-aligned accumulation. Silver is essential to modern power systems. It is used in solar energy infrastructure, advanced electronics, military-grade communications, grid stabilization technologies, countries that control silver control bottlenecks in these systems. And bottlenecks are leverage. Here is the detail that rarely enters public discussion. Strategic silver does not return to markets. Another change followed: custodianship. Large banks and clearing institutions reduced exposure to physical settlement risk. Instead, they expanded custody services, holding silver on behalf of sovereign and institutional clients without the obligation to make it available for delivery. This creates a silent imbalance. Metal exists, but it is no longer liquid, and now the system faces a constraint, not of price, but of access. Because when access tightens, contracts stop behaving like promises and start behaving like options. And options get exercised all at once. At this stage, silver is no longer being drained quietly. It is being promised more times than it can be delivered. That is the definition of leverage. For every ounce of physical silver available for delivery, there are dozens of paper claims. Futures contracts, options, ETFs, swaps. Most of these instruments were designed for liquidity, not redemption. As long as participants accept cash settlement, the system functions. But leverage only works until too many participants ask the same question. Where's the metal? Silver is not shorted evenly. It is concentrated. A small number of institutions hold a disproportionate share of short exposure. These positions were built over years, under the assumption that physical delivery demand would remain low. That assumption is now failing. When markets are calm, contracts roll forward. When stress appears, participants demand delivery. Even a small percentage requesting physical settlement can overwhelm registered inventories. This is not theory, it is arithmetic. And here is the danger. Short positions cannot be closed with cash. When the counterparty wants metal, this is why silver shortages do not resolve gradually. They remain invisible until they break through all at once. And when that happens, price does not adjust. It reprices. When delivery pressure builds, markets do not fail immediately. They adapt. An adaptation is rarely announced as an emergency. It is framed as a procedural adjustment. Before a breakdown occurs, something else happens first. Volatility is suppressed. Margin requirements change. Position limits adjust. Settlement options expand. Each move appears rational. But together, they serve one purpose: delay delivery pressure. These mechanisms are not designed to protect investors. They are designed to protect the system. When physical settlement becomes difficult, cash becomes the preferred resolution. Not because participants want it, but because it is offered as the path of least resistance. Premiums appear. Incentives increase. Delivery timelines extend. Metal is not denied. It is deferred. But deferral does not reduce demand. It compounds it. Markets run on confidence, not metal. As long as participants believe delivery is possible, they accept delay. But once doubt enters, behavior changes rapidly. Contracts are no longer traded for exposure. They are held for redemption. This is the moment systems become unstable. Not because of shortages, but because of loss of trust. At this point, only two outcomes remain. Either confidence is restored through credibility, or price is used to ration demand. And historically, price is always the last lever pulled. When systems reach this stage, nothing dramatic happens at first. No crash, no headlines, no alarms. The change appears subtle. Silver stops being offered and starts being withheld. Real shortages do not begin on exchanges. They begin downstream. Retail products delay. Premiums detach from spot. Industrial buyers sign private contracts outside public markets. Spot price remains calm, while the real price moves somewhere else. At this moment, price is no longer the signal. Availability is. When availability tightens, silver does not reprice slowly. It gaps, not because of speculation, but because inventory is suddenly spoken for. Industrial users cannot pause production. Governments cannot pause infrastructure. They pay whatever clears supply. This is when paper markets lose authority and physical markets take control. Every commodity shortage follows the same arc. Denial, delay, intervention, repricing. Silver is not unique. It is simply late. By the time price reflects reality, positioning opportunities are gone. This is the quiet phase. Before repricing, where choice still exists, not because silver is cheap, but because access still exists. Once that changes, decisions are made for you. This channel exists to document moments like this before they become obvious. Because once a shortage is acknowledged, it is already over. So the real question is not what silver will do. It is when the system admits it has lost control. What if you recognize the signal before the repricing? Comment your thoughts below and subscribe, because the next shift will not be announced.